Good morning, and you are welcome to our class on WACC, Weighted Average Cost of Capital. And this is part two of the business finance, i.e., the financing decisions. This is the part two of it. So, in this video, we are looking at weighted average cost of capital. Weighted average. All right. So in the first video, we learned that when we want to finance our business, we need to finance our non-current assets. Non-current assets, of course, this is WACC. We need to finance our non-current assets. Not only non-current assets, we also thought of financing some working capital, right? And we've gone through that series of lecture. So we also need to finance our working capital, because these are the source of the business running. Now, in accounting or reporting, you learned accounting equation, which is asset is equal to equity plus liability. Now, the asset we are talking about here includes NCA and CA. So basically that is that. So that is the picture we are trying to draw for you. So this is the NCA, the non-current asset, the working capital, the CA. All right. So what happens to this? What happens to this is that we need to finance this. We need to finance it. So it's either you finance it from your equity holders or you finance it from your debt holders. So on one hand, you are going to finance this one, this issue, all right, or non-current assets and working capital. You are going to finance it via equity, or you are going to finance it via debt. Now, these are the sources of finance, and that is what we did in the first video, all right, the part one of business finance. We know that these are the finance, but how much will it cost us? And the cost, we will express it in the form of a percentage. For us to get the money from the equity people and the debt people, or the debt holders or the equity shareholders, to be able to finance our working capital. So we are going to calculate how much it will cost us in terms of percentages, rates. All right, so that is what we are going to do. Now, so what we are doing here is the cost of capital. So what then is the cost of capital? So the cost of capital herein, as you see, is for the purposes of calculating a discount factor for your NPV analysis. We did that before. Or you are looking at it as a cutoff rate for your IRR. That is one part of the definition, and we did that in the investment appraiser. But the cost of capital too is the price that is paid for using funds to finance your corporate project. So how much it is going to cost you to get the fund to finance your project. So that is basically it. How much is it going to cost us? So let's say I have a vision in mind, all right, and I want to build a library, okay, a very big library. But I want to finance the project. I can either go to somebody to come and invest in my business as an equity holder, or raise money in the form of debt. I will go and borrow to finance it. Now, how much will it cost me if I'm going to do that? If I source from the equity people and at the same time source for the debt holders, then on average, how much is that going to cost me on average? And that is what we are trying to calculate when we are doing weighted average cost of capital, also called what? WACC. Now, So what we need to understand, therefore, is the fact that the cost of capital has some elements of it. We have part that is free. So the element of cost of capital, we have the risk-free rate of return. All right. We have a level where the return expected of an investor is zero risk. So he wants to have a return, but the investment that he's doing is a zero risk. A typical example of this is investing in treasury bill. All right. T-bills. It is deemed risk-free. All right. And also we have people who want more money and therefore they will go for those ones that are higher level, having higher level of risk, and they will go for that because the higher the risk, the higher the money. All right. So that is that. The higher the risk, the higher the return. So that is that. Now, so we are going to look at the various sources of finance, which we did in our first video. But here we are going to look at how much it is going to cost us and see how we will calculate that. So if we take WACC, we need to now factor the sources of finance, which we did in the part 1 of the business finance or financing decisions. We know that we can source money from equity shareholders. And by this one, we are looking at the ordinary shareholders, the ordinary. We know that we can go to them for funds. But we also know that we can go to get money in the form of shares, but this one is from the preference shareholders. Preference shares. Preference shares. We also know that we can use debt financing. Debt financing. Sometimes in reporting, IAS 32 describe preference share as debt. It splits the preference share into two and say that there is redeemable preference share, there is irredeemable preference share. But the redeemable ones, because you have a present obligation to pay the redemption, it is a liability. But the irredeemable ones, because there is no obligation on you to pay redemption, it becomes ordinary. So that is what IAS 32 try to teach. But here we are not really concerned with the division. But when we are doing the preference share, we will learn how to do the cost of financing using a redeemable and cost of financing using an irredeemable. All right. So basically that is that. So let's look at how we are going to calculate the cost of capital for the equity holders. Now, we have 3 methodologies of calculating the cost of capital for equity holders, and you have to be careful. The examiner can bring any of such for you to work. The first one that we are going to look at is called the dividend valuation model. So DVM. The dividend valuation model. We are going to use the dividend valuation model to calculate equity cost of capital. So we are looking at this one now. Then number 2, we are going, so this one is called the DVN model. Then number 2, we are going to learn how to calculate cost of capital using the capital asset pricing model. Capital asset pricing model. And this one is called the CAPM. So we will use the CAPM. But thirdly, we will have to calculate cost of capital using the Modigliani and Miller's theory. So those people propose a way of calculating the cost of capital, and it is Modigliani and Miller's theory. So preposition 2. So we talk of the M&M theory. So these are the 3 ways of calculating the cost of capital. Now, when we are looking at the preference share, like I said, we will learn how to calculate 1, redeemable, preferentials. Then 2, we will learn how to calculate the cost of capital or raising fund from the irredeemable. The irredeemable preferentials. All right, then when we come to the debt, of course, we have all forms of debt. We have debenture, we have short-term debt, bank loan, and all those ones. So here we will talk about the long-term ones. So we will talk about the loans, the long-term ones. We will learn how to calculate it. That's the debenture, loans, and all those ones. All right. And we will learn how to calculate the cost of capital for convertibles, convertible debt. And lastly, we will look at short-term tradable debt. So these are the overview of what we're going to do. Maybe the videos will be segregated in parts so that we can have each one of them in perspective. All right. So first thing first, we need to learn how to calculate the cost of capital using the DVM model. So we are calculating cost of equity capital. So the first one that we are doing will be cost of equity capital. And the cost of equity capital, the first one that we will be looking at will be the we will be looking at the DVM model first. So let's look at A, the dividend valuation, using the dividend valuation model formula. And of course, when we go to business valuation, we will still keep to this business valuation model. All right. So that is the first one that we are going to look at. Now, the dividend valuation model basically says that the value of a company is determined by the cash flows in perpetuity. So if you can have the cash flow of a business for the future, then it means that you can actually calculate the cost of capital using that cash flow. So you know that in determining a value of a business using their cash flow, what is going to happen is that you will need, one, the future income stream. If you want to value a business, we call that in also the income model. If you want to value a business, the assumption is that you will need the future cash flow. Future cash flow. Not only that, all right, because out of the future cash flow is where you are going to pay dividend, because dividend is paid out of retained earnings. So if we know how much you are going to earn your cash flow, then it means that the cash flow will generate the dividend. And it also tells us that dividend will be paid in perpetuity, because so long as the company is existing for a going concern, dividend will be paid. All right. So it means the assumption again here is that dividend is paid in perpetuity. So the business will continue to pay dividend. The last thing about this assumption of using the dividend valuation model is that the dividend can grow at a constant rate, or it cannot grow. So the dividend may be constant or can grow at a fixed rate. So this one is about dividend growth. Mathematically, the DVM model says that if we want to value a business, the present value of the business, therefore, is the cash flow. If we can get the cash flow, especially the inflows, the net cash inflows, then we divide by the rate of return, we can get the value of a company. So this is the value of a company. So therefore, the rate of return here is our focus. So it is saying that because of this, we can say that The value of a business is actually its share price. So the price of the company, that's the market value of the business. And so we can have that by taking the dividend, which will be paid through the cash flow, the net cash flow, divided by the cost of equity, because dividend is paid to these equity holders. So mathematically, we can say that PO is equal to D dividend divided by cost of equity. So now the cost of equity's presentation, cost of equity capital is defined by KE. All right, K subscript E. So now, therefore, by change of subject, we can find KE. So KE, therefore, which is what we are learning, the cost of equity capital, is therefore can be given by this change of subject. And by the change of subject, what do we have? We will have, we will cross multiply and divide. So you know that when you do this, you have DO is equal to POKE. So since we want KE, here will be by PO, here will be by PO. Then KE, therefore, is DO over PO. So that is that. Now, assuming that the dividends are going to grow. So if dividend will grow, because we said that dividend can grow, assuming that dividend can grow, so if there is growth, with growth, the KE formula will be equal to something like DO 1 plus G, that is the growth, all divided by PO. All right, so with growth, that is how it is going to be. Now, you realize that plus G, all right, will show up at the end. That is with growth, all right, with growth, if the dividends are going to grow. Now, with growth and issue cost, maybe they issued ordinary shareholders, it cost them something, transaction cost. The formula, therefore, will become DO 1 plus G all over PO plus G. Then because of the issue cost, we put here into bracket 1 minus F. So this is that. So the comprehensive formula of calculating cost of equity capital using the dividend valuation model is this. So when all things are present, this is how it is going to be. That is how it is going to be. Now, so what is D? O. DO is dividend just paid. And the word paid is very important. Dividend just paid. Not dividend that has not been paid. Is the dividend just paid. All right. So the dividend that has been paid. Okay. Then what is 1? 1 means 1. What is G? G is growth. All right. But the growth, how do we find growth? We find growth by using two main methods. The method 1 is called the dividend growth model. All right, the dividend growth model. Now, the dividend growth model says that if I want G, my growth, it is going to be given by the dividend that I have today, the one just paid, divided by the dividend that was ever paid first time. So the dividend that was ever paid first time. So if the dividend was paid like first one was paid 5 years ago, D1 will be the dividend at that 5 years. Then DO will be the dividend of this year, the current year. All right. Raised to the power 1 over n, all minus 1. All right. The danger is about this n. This n is the number of times dividend has grown. Number of times dividend has grown. The D1 has grown. So since we pay dividend for the very first ever time, how many times has it grown? Now, you have to be careful because let's say I have year, this is years. Year 1, 2, 3, 4, and 5. And these are my dividends. Let's say first year dividend is 20 cedis, second year 30 cedis, 40 cedis, 50 cedis, let's say 60 cedis. What will my formula be? How will it be in terms of calculating dividend growth, the G? Now, we will say that G is equal to DO, the dividend that has been paid, the current year. This is the very current year I'm standing in. So, this one will be like, let's say 2024, 2023, 2022, 2021, and 2020. All right. So, 2020, sorry. So D1 or DO first will be my 60. That is what it will be. What is D1? D1 will be which one? Yes, your guess is as good as mine. Is the 20. So that is that. Then 1 over N. N is the number of times dividend has been growing. How many times has the dividend grown? You need to be careful because dividend grew from here to here. 1, here to here. Second time, it grew from here to here the third time, and it grew from here to here the fourth time. So how it is growing, how many times it has grown. You can't say 5 because here you don't see growth. It is what is there. But you saw that it was growing year on year, and the count is 4. So it will be 4 or minus 1. And that is how we find our dividend growth. So if I want to go further to calculate this, then what I have will be 60 divided by 20. All right, I have 3. Then I raise it to the power 1 over 4. All right. Then I have 1.31607, blah, blah, blah. Then I deduct the 1. So here my answer will be 0.316 something. Now, therefore, I can say my dividend has grown 31%, 31.60 or 61%. So that is that. If I'm rounding it to the nearest whole number, I can say my dividend has grown 30%. All right. So that is the rate. That is how you calculate it. That is how you use the dividend growth model to calculate the growth. All right. That is it. Then what do we need again? We need F, right? Now, before F, there is PO. All right. So PO. What is PO? PO is the price of the company's share. Price per unit of the company share. But the price should be ex-div. Ex-div. What do we mean by that? Ex-div means that we have already paid the dividend that should be paid. Now, this is the understanding you need to have, and this is the diagram I have to show you. All right. The thing should be an ex-div share price. All right. So why? Because we said that the dividend growth model is based on the perpetuity formula. All right. And the fact that in the perpetuity formula, dividends are paid at the end of each year. So dividend is paid at the end of each year. But a share price is quoted on this basis is termed as an ex-div. So when we say that the share price of today is 10 ex-div, then it means that we know that dividend has been paid or dividend is ahead. So this is what we say. So this is it. All right. Ex-div is when dividend has been paid. Because if I say the value of my share is 5 cedis today, we are saying that dividend has already been paid and we are looking at it at the end of the year. But so you see, if I've paid the dividend, then it means that the price of the share is ex-div. If I'm yet to pay the dividend before dividend is paid, it is called cum-div, which means that the price of the shares that I've quoted includes a dividend that I will have to be paying. But we want the dividend ex-div. And so, therefore, to find the dividend ex-div, if you are giving cum-div, then it means you need to take away the dividend that is about to be paid or the dividend due to be paid. All right. about to be paid or the dividend due. Now, when you have that, then you can get your ex-div. And bear in mind, we always need ex-div, ex-dividend price, ex-dividend PO. Take note of that. So we will always need ex-dividend PO. All right, so that is that. Then we come to F. What is F? F means issue cost. All right, how much it costs us to issue a share to raise a finance. So issue cost per unit. All right, don't forget everything that is here is dividend per share, growth, and also the price is per share. All right, so everything in here is per share. So this is how we find the growth, the first method of finding growth in the DVM model. There's a second method of finding growth. The second method of finding growth is using the Gordon's growth model. So G can also be found by using the Gordon's growth model. So depending on the question, you know which one to use. All right. The variables that are giving you, you know which one to use. The Gordon's growth model says growth is equal to R multiplied by B. R multiplied by B. What do we refer to as R here? Of course, probably you've done man accounting. This is called row A, return on asset. And how do you find return on asset? Return on asset is what? Profit after tax, right? The profit available to ordinary shareholders. So please, if there is any preference share, please take it out. All right, minus preference share dividend, take it out. Because we are looking at only profit available to ordinary shareholders. Ordinary shareholders, please. So we are not even considering irredeemable preference share or redeemable preference share. We are saying profit that is available to only ordinary shareholders divided by shareholders fund. And you know what shareholders fund is? Yes, that is what we call capital employed. Now, it includes your stated capital, your retained earnings, your share reserves, share premium, and any capital reserves. All right, so this is that. This is also called income surplus. So the equity side of your balance sheet is what we are looking at. Okay. Then what is B? B is called retention. All right. Or you can call it retention. Now, what do we mean by that? What we mean is that the part of the money that the entity has kept after paying out its dividend, the part of the money the entity keeps after paying out its dividend. So how do we find B? B is given by 1 minus the payout ratio. Payout ratio. So when we pay out dividends, what is the money left for us? All right, what is the money left for us? So payout ratio, what is the formula for payout ratio? The dividend that I have paid out of what? My earnings per share. So that is that. That is payout ratio. So this is that. So sometimes you'll be given the variables, you have to fix them in, okay? You have to find a way to fix them in. All right, so that is fine. So now, what we need to do is to pick up some illustration and perform on that. So let's go to our favorite manual. All right, and please try and get a copy. It will help you. Just contact the number and it will help you. All right, so that is that. So we have our first illustration to calculate the cost of capital. That is using the DVM model. All right, so it says that the current share price is 140 pesos. That is like 1 CD, 40 pesos, right? And the dividend of 8 pesos is due to be paid. We should calculate the value PO, the ex-div share price. So what is that? Since dividend is due to be paid, it makes it cum div. So if I take the share price, like you see 140, I need to take away the 8 to get the ex-div. So that is that. It's simple. If the dividend has just been paid, then it means the price is already ex-div. But if dividend is about to be paid, then it means that we need to subtract it from the share price, because like we said, we need the ex-div. Very, very important. All right. Then this illustration 2 says D company is about to pay dividends. So that one too also makes it a cum div. The shareholders expect dividend to grow by 6%. D's current share price is 1.25. So first of all, we know that the formula KE is given by DO if there is growth, 1 plus G over PO. If there is issue cost, in this question, there is no issue cost. So we just do plus G. All right. So what has been given to us? The DO, which is the dividend. All right. The dividend. So a dividend is about to be paid, but that is the dividend that we all we need is DO. We need that dividend. So the dividend is what? 0.15. And there is growth. What is growth? 6%. So 1 plus 0.06. All right. Then the PO, we need PO ex div. All right. Because this dividend is cum div, but we need to make the prices ex div. So if the price is 1.25 and the dividend is about to be paid, it means we need to take away that 0.15, and that will make it 1.10. That's basically it. So that is what it is going to give us. So we have 1.10 here. Now, when you do the calculation, well, you realize that your KE is at 20.5%. So basically, that is that. So that is how you go around it. Can you do this one? Ordinary share is 10 million. Price is 4. But this price, what kind of price is that? It says dividend of 0.8 has just been paid, meaning that this price is what? Ex-div. All right. Now, it now desired to raise 2 million by means of a new share. The issue cost is expected to be 140. So if he's raising 2 million, there is a cost of that. So each issue cost per the raising of the share is how much? Per share raised. So it's 140 divided by 2 million. And that gives me 0.07. That is the issue cost, is 7%. Now, and it says that we should calculate the cost of equity and the net issue cost. The net issue cost. All right. So now, what do we do? You find straight away that, oh, my KE is given by DO, 1 plus G, all over PO, 1 minus F plus O plus G. So if I now put this in, what is the dividend? 0.8. Growth, what was growth? 10%, so that would be 1.1. All right. O plus 0.1, that is the growth. What is the price? Price is 4 into bracket 1 minus 0.07. So that is that. So when you calculate this, you definitely get the answer that has been raised here. So this is it. You have your 33.66%. All right. So that is that. Okay. So if you want to know how much they will get from raising the 2 million, you take the 2 million, you take away the issue cost, and you have the net amount that they will receive. So basically, that is that. So that is how you do the cost of capital using the dividend valuation model. All right. So let's go to the next one, how we use the CAPM to do the calculation of the cost of equity. So we come to method 2. We are using the CAPM, capital asset pricing model. Now, in learning CAPM, of course, this is an advanced tuition going on. You have to understand that CAPM has 3 aspects of it. We have the portfolio aspect. That is CAPM. And of course, straight away, we are going to use the CAPM to calculate cost of capital in the easy way. But we need to see the various facets of it. The examiner is very cunning. We need to really understand that. So we will look at the portfolio theory. Okay. Then we will also look at what we call the CAPM formula, which is usually the one that we need in terms of calculating the cost of capital. Then lastly, we will look at risk, which is defined into systematic risk and unsystematic risk. All right, so we will look at the systematic and the unsystematic. All right, so basically that is that. Now, where do we start from? Let's start from the portfolio theory. What does the portfolio theory say? Portfolio theory is the one that simply says that it is not advisable to put all your eggs in one basket, because when it slips your hand, you've lost everything. And so the portfolio theory is preaching diversification. Diversification. So it is basically says that don't put all your money into one investment, because if it slips, then that is it. Like you are growing, we tell you to learn how to invest, do financial savings, and you're a Ghanaian, for example, and you did debt, you went to buy government bond, and they now tell you that there is a domestic debt exchange program. You are going to suffer for it. So assuming you have splitted your money part into, let's say you bought a Uber car to do Uber business, you did some in the financial sector. I mean, when the financial sector gets you, the Uber will be working, or probably you went to farming like that. So all that the portfolio theory is saying is that we need to split. All right, let's split the money, because it is risky to put all your finance in one bag. Please, this is my advice. Don't use this in a relationship, because some of the ladies have the opinion that, and even the guys, that they should not put all their eggs in one basket. That is very bad. All right. So when it comes to you and your wife, or you in life, if you are trying to date one at a time. All right. If you are married, you and your wife or your husband, that's it. Put all the eggs in that basket. All right. You'll be fine. All right. So that is that. Don't do side chickment. All right. So basically, that is that. All right. So we are going to learn how we will carry out our portfolio theory concept in terms of diversification. Now, here, what we're going to do is that here it is really about learning how to do standard deviation. Standard deviation. And also doing the mean concept. Now, what is it saying? You see, here it basically says that the mean is return. The money that you get, all right, is your mean, the return. And it talks about standard deviation being the risk aspect. So the return that you get from a portfolio and the risk that are associated with that. So we used to have a very long formula to calculate this sort of thing, all right? And I will take my time to do that in a different video, okay? So that is that. I will really take my time to do that so that academicians will have benefit of that. Now, so what are we doing here? So this is the graph that we talked about, and this is the whole concept of the portfolio theory, which I've summarized to you in terms of you diversifying. All right, so diversify your investment. All right, and the fact that it talks about risk and return. All right, risk and return. So the risk, like I said, is the uncertainty surrounding your return, which is the standard deviation. All right. Then it talks about the return itself, which is the mean. Now, how do we calculate mean? And how do we calculate standard deviation? So when you are calculating mean, you need to understand the data that you have. Is it group data or ungroup data? So we have mean of a group data, we have mean of ungroup data. So the formula for doing the mean is the return. Now, what are the return? The return comes from our very first lecture. The return of an investor. That's where it comes from. Don't forget that. Where did we say our shareholder receive their wealth from? Is one, from the dividend that they will receive. Not only that, where else? Plus the share price differences. All right, so P1 minus PO. So share price. So that is that. So that is where we can get the return. In expressing that in a percentage, we will do all over PO, right, multiplied by 100%. So that is how we find our mean. All right, that's how we find our mean. Then we will learn how to do the standard deviation. How do we find standard deviation? First, we find the mean. All right, so you find your mean, which is your return. Then for each of the data points, you will square that. So find the square of that distance to the mean. I mean, that is that. You will sum up your values in your step 2 and you divide it by the number of data points. Then you take the square root of it. So we are going to practice that. Now, so this is it. For example, the mean to, if at the start somebody had 800 and now at the end it is having 900, it means that and it's also paid dividend for a year. What you see is that if you want to calculate the mean, the dividend is 200 plus the P1, that is the dividend at the end, the price at the end, minus 800. All right, so that is that. If I want it in percentages, divided by this 100%, and that is what you see here, and you have 37.5. That is the mean, the return. Mean is what the person gets, the return. But the standard deviation is the issue surrounding it. All right. So let's look at this question, which is actually a past question, where it says that Crown has a mixture of investment portfolio. So far as you see a portfolio, then the portfolio theory must come to mind. So he has a stock. All right, he has a stock. Now, the stock that he has is saying that we have stock A, we have stock B. All right, and the historical performance of the return on stock A, on the stocks are shown as you see. So these are the years, and these are the returns. One return, it means that the first year they had negative return and it started getting better. So we have been asked to calculate the average return of each stock during the period for the entire period. So that is average. Average means that you have to divide it by the number of the points. So here, the number of the points is 1, 2, 3, 4, and 5. So that is that. So that is that. So what do we do? And this is the return. That is the return for each one of them. So if we want the average return, so let's say, let's solve the question. So we have stock A and we have stock B. So what is the average return? So A, average return, which means that we need to add all the returns and do the average. So the first one here, the average return will be minus 10 plus 18 plus 39 plus 14 plus 33. All divided by 5. That is that. That is how you find average. So here, minus 3 plus 21 plus 44 plus 4 plus 28, all divided by 5. So that is how we find the average. Now, if I punch my calculator, let's go. If I punch my calculator, I have this one to be 18%. All right, in the form of a percentage. Okay, so that is that. It has to always be in the form of a. So everything is by 100%. By 100%. So I have 18%. Interestingly, this one too is 18%. So that is what I have. So that is it. So that is how you do the average for the years. Now B, it says that calculate the average return of the portfolio during the period if Crown held 50% of stock A and 50% of stock B. So now it means that this is simple. What is the average return if he does 50% here and 50% here? That means that he will also get the return 0.5, that is 50% of the 18%. And you also get 50% of this 18%. So that is it. So here, well, I have 9%, or if I do it in terms of percentages, I think this thing gives me, because this thing is like 18.8, right? So if you, this side should be 18.8. So you can do it, because minus 10 again, plus 18 plus 39 plus 14 plus 33 really gives 94. Then when you divide by 5, it gives you 18.8 is the rounding that I did, that I decided not to bring. But for the purposes of what we are doing now, let me just write the 18.8 totally. 18.8%. All right, so there is 0.8 in this. So it's 18.8%. The same for the other side too. When we have 3 plus 21, minus 3 plus 21 plus 44 plus the 4 plus the 28, that too is 94. So the two places were all 18.8. So that is it. So if I do the 18.8, what I really get is 9.4% for here and 9.4% for here. So it means that this person, at the end of the day, if he does 50% here, does 50% here, his return is going to be 18.8. So that is that. That is him doing diversification. Then he says that we should calculate the return on the portfolio using standard deviation approach. So here, what is going to happen? We are using standard deviation approach. Using the standard deviation approach, what is going to happen? Do you know this? You remember the sequence of the standard deviation, where we said that first of all, find the mean. You remember? So first of all, find the mean. Okay, so we said that. So you have to understand this standard deviation is given by, especially standard deviation of an ungrouped data. This one is, if you have standard deviation of an ungrouped data, the formula for your standard deviation will be given by, for an ungrouped data, what you will have, you remember we said square root them, and that is the taking of the square root. We said that you will find the mean and you will sum it up. So it means summation of mean. All right, so this is how you do it. The one that you are squaring, like a variance sort of. All right, then you divide it, because it's an ungrouped data, you divide it by n minus 1. So you see that the data is in 5 odd. All right, so you do n minus 1. So if we want to apply this one to our work, mean of a group data, it is just divided by n. There is no minus 1. So what are we going to do? So if we take stock A, standard deviation of stock A, for example, what we are going to do is that we are going to sum up everything. So sigma into bracket. We are going to do, for example, we need to first, this one is the figure that you see, the X is the means. So this one, the returns. So that is what you have. Then you are going to do the average mean square. This is X is the return. The U here, this is mean. That is how you write mean. Mean square, all right? So that is that. Okay, so you have to be very careful of that. Let me rewrite this formula. I think the square should be outside. It should be outside. So let me rewrite it well for you. So it's like this. X minus the mean average square. Oh, I've done it again. So square. You are squaring what you have in here. So if I am doing this, if I take stock A, it will be minus 10. All right. That minus 10. That is what I have. Minus this part, that is the X and the mean. So the X is what I've done. Minus this one, my mean was 18.8. All right. Then I will square it. So I will do for all of them plus the second one, which is 18 minus 18.8 square. So that is that. Plus the third one is 39 minus 18.8 square. So it will be long. So I'm left with 14 and 33, right? So plus, we have to elongate this into bracket 14 minus 18.8 square. All right. Plus the last one. What was it? 33. All right. So 33 minus 18.8 square. So that is that. Okay. It's an ungroup data, like said. So it will be n minus 1, which is a 5 minus 1. N is the number of the data. So 2010 to 2014 was 5 years. So that is what we do. And you have to do the same thing for the B stock. Same thing. So 3, 21, 44, 4, and 28. So the standard deviation for stock B will also be given by 3. So it's minus 3. So the summation is minus 3. It was also 18.8 square plus 21 minus 18.8 square. The next one was 44. 44 minus 18.8 square plus the next one was 4 and 28. Yeah. So 4 minus 18.8 square, then plus 28 minus 18.8 square, all over 5 minus 1. All right, so that is that. If you punch this, first punch everything in here, add it, divide, then square root it. So I have, let's say, 19.12. So that is that. So this one gives me 19.12%. So that is that. Then the next one, when I have this one, punching is 18.63 or 83. Yeah, 83. So 18.83%. So that is how we find the standard deviation. All right, so that is that. All right, sometimes even you can be given for you to do covariance analysis, but this is financial management. At this level, you will not be bothered to go in that much. All right, so this is what you do. So this is a past question, and that is what we do with it. The next thing we need to learn how to do, don't forget, per what we have here, apart from the CAPM analysis, all right, we need to also deal with the CAPM formula. Apart from the portfolio analysis, we need to also use the formula. Now, the CAPM formula is simple. The CAPM formula says if I want the cost of equity, all right, it will be given to me by, it says that there is risk-free rate of return plus, you remember, it says that return includes risk-free and premium. Beta into bracket RM minus RF. All right. So in the CAPM analysis, there is a risk-free component. There is a premium component. Now, what is risk-free? Risk-free is the level of investment you do. There is no risk. A typical example is treasury bill, like I said before, treasury bill and government bonds. But unfortunately, if you are a Ghanaian, you can't accept the assumptions of CAPM. because we did government bond, we have suffered risk. So those are the things. But theoretically, risk-free is supposed to be anything you do with the government, like doing national service with the government of Ghana, where you are supposed to be paid a monthly allowance, given a contract. I think it's high time we start taking people on legally. So if you give somebody a contract that you pay him a non-taxable allowance of, is it 700 cedis something? At the end of every month with a specific date in the contract, and you wait 2 months time, 3 months time before you pay. I think these things are legal issues. Contract is signed. It's like, it looks as if in our part of the world, the government is doing people favor, but the government does nobody favor. Government don't give anybody, no, the president doesn't give anybody money from his pocket. It is the resources of the nation of which he takes salary from. Anybody working in the government aspect, you are not doing anybody's favor. It is the people's money that has put you there. It's very sad. Very, very sad. And you tend to kind of have a lordship. It's very sad in our part of the world. We pay you salary, but you still want to lord on us. It is sad. Very, very sad. Very, very sad. We pray these things will change. To change. Because they don't personally gift anybody any money. If you do a good project, it is our own money. It's very sad. Interesting. Let's move on. So that is it. Okay. So the beta is what we will analyze later into systematic and unsystematic. All right. Then the RM. So this is risk-free. The RM is market risk. All right. Market risk. And of course, you have the risk-free. But bear in mind, this aspect of the formula, RM here minus RF, is also called risk premium. Risk premium or market risk premium. So if you are giving a question where they give you the premium, it means the one in the bracket has been done for you already. All right. So that is that. So take note of that. And by this, that is how CAPM tells us to calculate the cost of equity. All right. So that is it. So you just have to put in the figures and you have it. So what is the risk-free? Then the beta. All right. So basically that is that. All right. Then let's look at the systematic and the unsystematic risk. All right. Shortly. All right. So let's take some theoretical understanding of what we've done. All right. So the risk to, let me explain the risk to you and get a theoretical understanding of what we've done. Now, what the risk aspect, the CAPM formula, there is risk aspect, and you see the beta for the risk. All right. Now, we have systematic risk and we have unsystematic risk. Now, systematic risk is related to the market. You can't control it. All right. It's like the way I explained the DDP that happened. I as an investor cannot explain that. The government is kind of imposed. So that kind of risk is a market variation risk. There has been changes in the system which you cannot control, and it is imposed on you, sort of. But the unsystematic risk is the entity-specific risk. The entity-specific risk. And that is the one we can control, and that is the one we are trying to diversify so that we can save it. We can't do anything about this. I was told that at a point in this nation, Ghana, we used to have cars that were right-hand drive. All of a sudden, the government, they stood up and said, from tomorrow going, nobody is going to drive a car that is a right-hand drive anymore. So we all have to accept to the left hand. So if you have a car that was a right hand, that's the end of your car. You can't use it on the road again. And that is system-based, all right? So you don't have much control. But the entity also can impose certain risk on you. So why don't you buy a right-hand drive car and buy a left-hand drive car? But you bought, like, let's say 5 right-hand car, and now you have suffered for it due to government change. So to diversify that thing, you could have imposed on yourself buying the 2 sets. So when the issue comes, you can save yourself some aspect of your cars. So that is what we are talking about. So that is the systematic and the unsystematic risk that we are talking about. All right. So basically, that is that. So that is what you need to. So in the CAPM analysis, the beta that we are referring to here is actually the beta of the one that we can't do anything about. It is called the systematic risk. All right. That is the one that we are talking about. That is the one. We are not talking about the unsystematic, because the unsystematic, it differs from each entity's own. But this is a formula. And in a formula, when something, we use formula because something is constant. All right. That's why it is a formula. If things change, it can be. All right. So that is that. So the beta we use there is the systematic. So let's get some theoretical analysis now. So what we have explained. So like I said, the beta that is there is the systematic risk. All right. So that is that. And so that is the implication of the CAPM. It says that if you want to avoid risk altogether, then you must entirely invest in a risk-free security, such as government debt. Please, this thing, be careful if you're a Ghanaian. So because this thing has its own effect. We learned this, we did, and we suffered for us. So we suffered for that. But elsewhere, it's safe. It's really safe. And so if you hold an undiversified portfolio, it means that you are going to suffer both systematic and non-systematic risk. But if you balance it, you will manage your unsystematic risk. The one that you are likely to suffer is only the systematic risk. All right. So an investor who individual shares will have systematic risk characteristics, which are different to the market average. All right. So basically, that is that. So, like I said, the CAPM formula that we are using is focused on only the systematic risk. So the beta that you see there is a measure of the systematic risk. So that is that. So you have to understand the concept of what we've tried to. So the CAPM formula uses the beta factor to measure the share of volatility. So the risk aspect of it is the measure of the systematic risk. All right. So that is the beta factor. So the beta factor we have in the CAPM is the measure of the systematic risk of a security relative to the market. All right. So basically, that is that. Now, the beta factor of the market as a whole is equal to 1. The market as a whole. So market risk, it says that market risk makes market return volatile. So the beta is the symbol or is the yardstick for that. All right. So the risk-free rate of return is the RF, and we are talking about those ones that are short-term government debt, like Treasury bill. I think Treasury bill is still a little safe, and that one you can do. Then the market premium is talking about the difference. I told you that this part is the market premium, so be careful about that. All right, so that is that. Beta talks about sensitivity. So if the investment is risk-free, then the beta is 0. I mean, that is that. The beta is 0. If an investment is very riskier, then it means that the beta is greater than 1. If the investment is less risky, it means the beta is less than 1, because 1 is the symbolism of the risk. All right, so basically that is that. All right. So the factors that goes into the determination of the beta is sensitivity of the cash flows, i.e. the volatility. Now, for example, new cars are very sensitive than basic food. Where everybody, a new car comes, people are kind of sensitive. They want to be the first person to buy it and all those things. Operational gearing too is one aspect, and financial gearing too is a system of risk. All right, so that is that. Now, the question is that which beta factor is to be used? We said that the beta is systematic. All right, now that is something you need to get in mind. The beta we are using is systematic. Now, there are 2 types of beta anyway. So let's talk about the beta. Whose symbol is this? We have beta assets. The beta that is for asset is for an ungeared company. So beta asset is for the ungeared. We call it beta A. It means the company is not geared. So it means that if there is a risk, it is the only risk that is relating to the systematic risk. It is the risk that is relating to only systematic risk. So bear in mind, beta A is just systematic. It means the company doesn't have any financial risk. There is no risk inflicted in the investment because of the company itself, but it is because of the market. All right. So basically, that is that. So the beta asset is the ungeared beta. Take note of that. Then we have beta equity. Equity beta, which is beta E. That is for what we call a geared company. So a geared company. So this one represents the systematic risk plus the unsystematic. Bear in mind, so beta E is both systematic and unsystematic. Beta A is only systematic. So please bear in mind that. And so, like I said, the beta that we use in the CAPM formula is the only one that focuses on systematic. So we say this one is both systematic and unsystematic. So the beta that we use in the CAPM formula, for which KE is equal to RF plus beta. This beta is beta A. Take note of that. So RM minus RF. So basically that is that. All right. So that is what you need to understand. Now, I've given you a tutorial advice in the book. In the exams, you might be de-gearing the proxy beta, equity beta, using a quoted company's gearing. And I will explain this part to you. Watch this. We have learned beta, all right? That the beta, we have beta A and we have beta E. Beta A is when the company is not geared. Beta E is when the company is geared, all right? And I mean, systematic and non-systematic. So the company that is doing the project, you have to focus on the company that is doing the project. Because if the company that is doing the project is not geared, but the project itself that is going to do, so let's say not geared means that you don't have debt. It means the company, this ungeared means that the company is financed. That company who is doing the project is financed with all equity. Its capital structure is all equity. There is no debt in it. That is the meaning of ungeared. There is no debt. But this company will be undertaking a project. But that project alone, they have to go and borrow money. So the project will be financed by debt and also portion of their equity. So it means that you cannot use a beta A for this project. Because as far as the project is concerned, it has both equity and debt. And so the project specific beta will be a beta E. That is that. Project specific beta. So if you are doing for the project, then it means that you have to focus on the beta E. All right. So basically that is that. Now, the thing is that if you want beta A, this is how you find beta A. So beta A is this one. You look at the formula very well. So we have this one. We have value of equity divided by value of equity plus value of debt. So the debt. So you take that one. So this is something we will do in WACC. So this one will be the VD 1 minus T all over VE plus VD 1 minus T. So, and you multiply, this is coming from debt, all right? So that is that, beta value for debt, that is BD. All plus, the equity side will be VE divided by VE plus VD, the same thing, 1 minus T, all right? Then multiply by BE. But you see, we said that beta A, in the beta A perspective, the company doesn't have debt. So this one will go away. Debt is assumed 0. So you see, the only thing we'll be left with in the formula is BA is equal to VE over VE plus VD, 1 minus T, 1 multiplied by this side, the beta of the equity. So that becomes that. But we are doing project specific. The project should be beta E. So because it has both debt and so if we are left with this formula, beta A being equal to VE plus VD, all right, and the VD is always with 1 minus T, so 1 minus T, and we are multiplying everything with what? Because the debt should be post-tax. We are multiplying everything by BE. Then we want BE. So first we use beta A, then we develop it. That is what we call gearing and degearing. All right. So we have to work it. All right. So it means that we want this one. We need to make this one the change of subject. But when you have these things, all you need to do is to put the figures and make this one the change of subject. Then you find the BE and you will use it to do the project. So let's take an example of this. And this too is a question that you must be careful. It is a likely exam question. You must be very, very careful about that. So, because in the past question, they've tried something similar before. Look at November 2020. They tried something similar before. So I'm going to go through this class to finish the equity up to this point. Then the next video, we will do how to calculate preference share and debt and combine it to calculate the WACC. So let's look at the illustration that is here. Let's look at the illustration. All right. So now, in this illustration, what do you see? This is the question. So let's start the question from here and try to deal with the question fully. All right. So we read the question. And in the question, this illustration 5, it says that the directors of Moreland Company, a company which has 75% of its operation in retail sector and 25% in manufacturing, is trying to derive a firm's cost of equity. However, since the company is not listed, it has been very difficult to determine the appropriate beta factor. Instead, the following information has been researched. Retail industry. Quoted retailers have average beta of 1.2, and it is average equity beta, beta E, and average gearing ratio of this. Then manufacturing also has this one. Quoted manufacturers have average equity of 1.5 and average gearing of this. The risk-free is 3%, equity risk premium is 6%, tax is 30%. Moreland Company, so the Moreland Company has his gearing is 50% debt and 50% equity. So assume that the risk on corporate debt is negligible. So what do we need to do? So in this particular case, we have to use somebody's company to help because this company is not listed. So we have the industry average. So in order to use the CAPM, we shall derive the, don't forget, we said the CAPM, we need to find the beta. And so we need to find the beta for the analysis that we are doing. Now, if for the specific project, all right, the people are using beta E. That is it. For the specific project, they are financing the thing with debt and with equity. But if the company is solely equity, they should use beta A. But if a company is geared and they are sourcing the funds from different places, it means that you have to focus on that and use the project-specific beta. So now, in the retail sector, what do we see? So in the retail sector, this is the information that we've had. Quoted company, they have beta E. Quoted company, beta E. So that is that. Average equity beta. That is what we have. Now, so if we take the retail sector, we will realize that the formula, that is beta A, is equal to VE plus VD, and the VD is always post-tax, so VD should be always 1 minus T multiplied by beta, the equity, the beta for the equity. All right, so that is that. Now, when we research this, what we are going to do is for the retail sector, we have equity beta. Equity beta. Now, which one is called the equity beta? Do you remember? Do you remember the one that is called equity beta? So equity beta. These are your betas. Equity beta is what? Beta E. All right. So that is what you need to understand. Okay, so let's slot it in and find our figures. So if beta E is given, then what is this? It says that the value of the company, the average gearing ratio is this. So that tells us that for this company, the VE is 20. Then we have 20 plus 80, 1 minus T. And the tax rate is 30%, so 1 minus 0.3. All multiplied by the equity beta of 1.2. So that is that. So what will we get? So you pick your calculator, the 80%, 0.8 multiplied by that part is 30%, so that will be 0.7, right? Okay. Plus 20. That the down one alone gives me like 20.56. Then I do 20 divided by that answer, multiply by 1.2, and I have my answer. The answer that I'm having here is giving me like 1.6 something. All right, so that is what I'm having. Okay, so that is that. So you jot that one down for now. Then you do the second. Go ahead and do the second one for the manufacturing. All right, so bear in mind. Oh, I think that it's debt to equity rather. So let me change the figures. Okay, let me change the figures. So it means that the top one should rather be the 80, VE, 80. Then here should be rather the other way around. So be careful also. 80 plus 20 multiplied by 1 minus T. So that one will make it 0.7. All right. So let me redo it. So I have, is the 20 that is by 0.7. That's 14 plus 80, 94. So 80 over that multiplied by 1.2. My new answer is 1.02. So that is what I have, 1.02. So that is beta A. All right, so that is what I have. Then you do same for the manufacturing. All right, you do same for the manufacturing. If you do for the manufacturing, because this guy that we are working for has 75% of his work in the of its operation in the retail, and 25. So we will calculate the portions of that. Okay, so that is that. So the manufacturing to the same formula. So what is the equity? Debt to equity. So the equity is the 55. So I have 55 plus into bracket 45. All right. And the 45 is 1 minus T. So the 45 will be multiplied by 0.7. That is 1 minus 0.3. Okay. So then what is the beta for that one? Beta, look at it too. Beta E is 1.45. So let's do that calculation too. So this one too is 0.92. 0.92. All right. So basically that is that, 0.92. So now this is for the industry. The industry. So now we come to what Morland is doing. So Morland's beta A, the company that we are working for, his beta will be, they told us that he has 75% Morland's beta A. 75% of Morland is into retail. So what did we get for the retail? That was 1.02. That is the first part of the beta. Then plus the other manufacturing, which is 25% of Morland, being for 0.92. So we need to work this around. All right. So 0.75 by 1.02, that's like a 0.77 rounded, because 0.65. Then 0.25 by 0.92, that gives me 0.23 rounded. So total is 1. So the beta A is 1. All right. So that is that. Beta A is 1. So what is beta A? Beta A is for a company that is not geared. It's for a company that is not geared, because that is it. But Morland company has a gearing. So, and he is doing that project. So it means that before we can calculate the CAPM, this is with the risk-free. This is the equity risk premium. Don't forget, they've given you premium. Premium means that they've given it to you. Then the tax is, we don't need the tax. But right now, we've used the tax to do what we have to do. Right now, we have said that if a company is ungeared, we will use beta A, because the beta A is the focus of the CAPM formula. Beta A is the focus of the CAPM formula. But if an entity is going to conduct a project and their company is geared, then it means that we need to use the project specific. So now this company is geared. So it means that his beta should be beta E, because that is that. His beta should be beta E. But how do we find it? Don't forget how we find beta A. We can use that one to generate our beta E. It was given by VE plus VD, 1 minus T, all multiplied by BE. So now we know Morland's beta A, which is 1. So 1 will be equal to, and Morland is 50%. So here will be 50, then 50 plus into bracket. So we have 50, 1 minus T. So 1 minus T was 0.7. All multiplied by beta E. We don't know beta E. So when we work this, what will we get? 50 by 0.7. All right. So 50 by 0.7 gives 35. So the down becomes 85. So 50 over 85. So what we get is 1 is equal to 0.588. I mean, it's a long thing, BE. So what I need to do is to divide here by 0.588 and here by 0.588. Then I will get my beta E. So if I do 1 divided by answer on my calculator, my beta E is 1.7. So my beta E is 1.7. So because the company is geared and it is going to suffer for both systematic and unsystematic, my CAPM formula, KE is going to be RF plus beta E, because this company is going to suffer both risk. So be careful. But the CAPM should be for somebody who has only systematic. So I told you the focus of that beta concept is systematic. But you see, if a company doesn't diversify, then it means that he will only face, he will not only face the systematic, he will also face the unsystematic. And that is what these people are doing. And unsystematic is the gearing aspect of it, because the more you invest in debt, the more you are becoming geared and the more you are becoming more riskier. You could save yourself from the unsystematic of finance and focus on only the equity. That one, the only thing that can happen to you is the unsystematic rate. So now it will become beta E Rm minus Rf. Don't forget what Rm minus Rf means. It can be given to you as premium. So we said that. So here the risk-free is 3%. We found our beta 1.7. All right. Then we multiply it by, this side is given together. They said they're giving us risk premium. The word premium has come in. So it means here is 0.06, which is 6%. All right, so we can now do the multiplication. My 1.7 will be multiplied by 0.06, then plus 0.03. So my answer, therefore, is 13.2%. That is my KE. So be careful. Sometimes you can be asked to find a beta in the question, and there is a past question like that, which you need to try and see. All right. Lastly, before we go, let me talk about the Modigliani. The third one, the Modigliani. Of course, Modigliani preposition 2 is another way of finding, what do we call it? The cost of equity. Modigliani and Miller preposition 2. So I'll just give you the formula. All right. Then in the next video, where we were going to talk about the cost of debt or preference share, probably we will deal with the past question of this one before we come to that. Or maybe we should deal with the past question right now and be fine, right? All right. So the Modigliani principle gives the cost of, so for them, they are saying that the cost of equity, KE, for a geared company is given by the cost of equity for an ungeared company plus the tax effect of it. So plus 1 minus T into bracket cost of ungeared minus cost of debt into bracket the debt value over the equity value. So basically, this is what the Modigliani says. So that is it. So the rationale behind the Modigliani is that as a firm increases its financial leverage, the gearing, that is, leverage means gearing, the raise to the equity investors also increases. That is it. So as the cost of, once a company increases debt, the cost of equity also increases. We will look at this thing in the optimal capital structure. All right. Why? Because the debt holder has prior claim over the equity holder. When a company is winding up, you pay the debt people before the equity. So once the debt people are increasing, the equity people also want to collect a higher cost of capital. So let's wrap up our class with this past question, the cost of equity. But there is a past question. Yeah. So the November 2022. Let's wrap up a class with that. So here it says that the director of Famicor Limited, a courier delivery company, is based in Ghana and is considering a proposal for setting up a subsidiary in the United States to provide courier services in Northern Africa. This is needed in case study too, because in case study, people go out and do investment. So it means that their capital structure must be taken care of. He said that the capital of this new subsidiary will be this. So there is 80% debt. The directors are not sure of what will be an appropriate discount factor, that's the cost of capital, for the North American company. You have been asked to recommend an appropriate discount factor for the project, but this is the information you have. This is the competition in US. In US, the industry is highly competitive. If Famicor set up in US, its main competitor, XFed, is this. Its capital structure is this. So just like we did in the retail sector, we've been given, but we don't have the beta for that. Probably it will be given downwards. Then it says that the market risk, the following statistics has been given for the market risk. So on equity stock of XFed, the competitor, That is, and that on a S&P 500 index, a proxy market portfolio. So all these things are proxies. Look at it. The average return is given. So you have them. You have these things. So you have them. You have everything. The things are given. Then it says that you analyze the correlation between the excess return of XFED and the excess return of S&P 500 index, and you obtain the correlation of this. Good. Because sometimes, you see, we had the formula for beta A, all right? Now, if you are given a correlation coefficient, it makes the job easier. All you need to do is to use your standard deviations and multiply it by because don't forget, beta is about risk. Beta, the concept of beta is about risk. And we learn in portfolio theory that risk is also what? Standard deviation. Don't forget that. So if you are giving the standard deviation with correlation coefficient, then it means that I can average the standard deviation to get my beta asset or my beta equity in this case. This is beta equity. All right. So that is that. Why beta equity? Because this company has both debt and assets, debt and equity. All right. So that is that. That is that. All right. So that is the proxies. So it means that this one, I can find my beta using the standard deviations and my correlation coefficient. This is pure statistics, all right? That is that. You can find it. Now, it says that the annual risk-free rate of return, annual risk-free rate of interest for a 10-year US Treasury bill is this. So that is risk-free. The expected return on the market is 7. What is expected return? RM. Take note of that. That is RM, expected return. XFED paid corporate tax of 30%. However, the effective corporate income tax on profit from Famico North American operation will be 35%. So take note of that. Take note of that. So which tax rate will we use? Because we are using issues of proxies, we will be using XFED. When we come to our own, then we will use our tax rate. All right. So that is that. When we come to Famico, we will use that. Okay, so that is that. Remember, like the example we did, the tax rate was constant for everybody. But here they are saying that when it comes to this side, the tax rate is different. All right. So when you are doing the proxies, the tax rate is still 30%. But when you come to your own, the tax rate is different. So take note of that. It's not difficult. You just have to follow suit. All right. We are required to calculate beta E, equity beta. It's simple. Like I said, since we have the correlation coefficient, beta E is given by the standard deviation that we have been given, the risks. So the standard deviation, this one, XFED, we've been getting, so standard deviation of XFED over the standard deviation of the entire market, multiplied by the correlation coefficient. So correlation coefficient. So that is it. That is how we find the beta, the risk. All right, the risk. So in this case, standard deviation is 0.1521 divided by 0.1875, correlation coefficient of 0.19. Simple. Simple. So 0.1521 divided by, what do we have here? Divided by 0.1875, right? 0.1875. That gives me 0.8112 multiplied by 0.91 gives me 0.7. So it gives me 0.7438. So let's round up to 0.74. So that is my beta, and that is beta E. Don't forget that, beta E. Then the question says that we need to derive an appropriate equity beta for Famicom. All right, and that is 4 marks. So we are now coming to look at the case of Famicom. Now, do you remember how we used to calculate the betas? And Famicom, is Famicom geared or Famicom is not geared? Where is Famicom? This is the competitor. So what information do we have on Famicom? And this is it. The project Famicom is going to do is also debt and equity. So at the end of the day, it is a Famicom's beta that we are going to use. So remember what we did? We used beta A. We did beta A, which is equal to VE plus VD 1 minus T multiplied by V of a proxy person. That is what we did. But in this case, and we used that proxy person's own to find BA, then we converted it to, now we already have BE, don't we? We already have BE. So, and the BE that we have, it was using the XFED, proxy XFED. So we should also be able to get the BA and regear to our own, all right? So that is that. So BA will be given by, where is XFED? XFED is this, 70 equity, 70 plus 30, 1 minus T. The tax rate is 30%. Don't forget that. So 1 minus 0.3. Multiply by this one of XFED, because we did it in XFED's market. So the correlation coefficient in XFED market help us to have BE. So that is that. So the BE is 0.74. So let's calculate this. 30 multiplied by 0.7, right? 0.7. That is that. I have 21 plus 70. Then 70 divided by answer. All right. That is 0.76. All right. So you have that. Then we multiply it. That is, you multiply this thing by 0.74. So that one will give me 0.56. BA is equal to, or 0.57. All right. So that is that. Okay. All right. So we have our beta A, but the beta A now that we've done is for XFED. All right. But as far as Moreland is, the project Moreland is going to do, Moreland is geared. It means that the beta we need to use for our CAPM, this CAPM formula, where KE is given by RF plus beta. The beta we need to use because the company is geared. And it is because the company is geared. So it means the beta we need to use is beta E. All right. RM minus RF. So that is that. And what we have is beta A for now. So we are going to re-gear it in terms of our company. So that is that. That is that. It means this beta is not geared, beta asset ungeared. We need to now re-gear it to our own. So the same formula, beta A is equal to VE plus VD, VE, yeah, plus VD, 1 minus T by VBE. So now that we have our BA, which is 0.57, all right, we are going to do it equal to, so now we focus on Moreland. So what are the figures of Moreland? The figures of Moreland are that equity is 20. So 20 and debt is 80. 81 minus, what is T? Because we are told that in this particular case, where is it? The one that Moreland, specific to Moreland, you will be paying a tax of 35%. So it means that we need to do 0.35. So be careful. This is a past question. Multiply by BE, which we are looking for. All right. So what will we get? 80 1 minus 30 is 0.65, right? 52 plus 20. So the 20 divided by that answer, I have 0.27. So here is 0.57, 0.27777. So let me make it 28 beta. So if I do 0.57 divided by my answer to get my beta, the beta that I am having here is looking around, is it 2.052? 2.052. Yeah, that's what I'm having. Now, so you to go through and confirm the figure. All right, so that is that. So, so if here is 0.28, so that is what you should do. All right, so that the beta that we have, the beta that I have is oh sorry, gone. So it's 0.57 divided by 0.28. All right, blah blah blah. So the beta that I have is 2.035 something. So let me make it 2.04. Okay, so I can keep it here. All right, so that is the beta E, all right, that I've received. So I can now slot it in my CAPM formula. All right, my CAPM formula is going to be KE. Where is risk free? Where is risk free? Risk free, risk free, risk free. Where are you? Risk free. Risk free. Okay. This is the tax rate. These are the information. Good. Risk free is 2.1%. Plus my beta 2.04. All right. The beta, sometimes when you do it, you can keep the figures on your calculator and run through it. So maybe there will be some small decimal changes. All right. So like, for example, if I did 80 multiplied by 0.65, right? That is 52. If I add that one to my 20, that is 72. So 20 divided by my answer gives me 0.7777 something. So I rounded it. So if I keep the answer and do 0.57 divided by answer, you realize that I have 0. So that one gives me like 2.052. So it depends. So if you do that, this one will be, if I want to keep that one, sorry, if I kept that one, it will be 2.052. So meaning that this side will also be 2.052 or 2.05, whichever one you want to write. If you want to keep it at 2 decimal places, tell the examiner all figures are rounded to 2 decimal places. Then you have into bracket, you were given, where are you? The expected return. All right. Yeah. So the expected return. The expected return is the RM. All right. On SP. What is SP? You should know that SP is the market, because they told us the market. It says that SP, a proxy market portfolio. XP is the market. So that means 7% minus 2.1%. So basically, this is it. Now, you go ahead and you do this. So I just multiply into bracket my answer that I've gotten into bracket 7 minus 2.1 bracket close. That side gives me 10 point something. Then when I do the plus 2.1 here, it gives me 12.15. So basically, that's my answer. That's it. All right, so that's my answer. So you fulfilled righteousness for this one, second one. Then they are saying that we should use Modigliani. Remember the Modigliani formula? Do you remember? So let's quote the Modigliani formula and run with it. So Modigliani, KEG, all right, is equal to cost of equity of an ungeared, of a geared is equal to that of an ungeared plus into bracket 1 minus T, right? Yeah. So you do that, then you bring another bracket, KEU. Do you remember it? Minus KD, then the D over A. So basically that is that. So to slot these things in our formula, we know that the cost of equity for a company that is geared, if you remember, that is our company, the company that is geared. So if our company that was geared, the KEU and all this quotation will be, so our KEG. So if we can do change of subject for all these things. So our KEG, all right, the cost of a geared company, because our company was geared, all right. Since our company was geared, what we're going to do is that we're going to write KEG, okay, and what is the answer that we will have? We will need to find KEU. We will need to find that the cost of equity for what do we call it? An ungeared company. So do we have an ungeared company? Remember, that is where the beta is A. So we can say that KEU is equal to, like the way we did, RF plus beta, but the beta will be beta A. Don't forget that, because we need to find KEU. We are finding the variables. And we need to find cost of equity for an ungeared company. An ungeared company uses beta this, then RM minus RF. All right, so if we use 2.1% plus beta A, what was our beta A? They loaded this question. I can tell you that. What was our beta A? Our beta A was 0.57. So 0.57, you need to find the variables. 0.57, so 0.57. RM minus IF, that's 7% minus 2.1%. All right, and when I do this, what will I get? So 7 minus 2.1 multiply, answer multiply by 0.57. Then what I get is plus 2.1. I get 4.893. So 2 decimal place will be 4.89. So that is what I have for my KEU. You use an ungeared. All right. So if I take my K, so that is it. In the formula, I found KEU. The next thing is 1 minus T. 1 minus T is the KEU is also found. What is KD? KD. Cost of debt. So KD. Now, cost of debt is, you see, is the risk-free, because we are looking at an ungeared company. So cost of debt is given. So the cost of debt is the risk-free, because they are borrowing, they are doing something in treasury bill, bond. That is it. So what we have for that one is 2.1%. That is it. What is the next item? The next item is V and E. V and E is the capital structure of our company. All right. T, don't forget, T for this guy is 35%. It's 35%. So it's something we need to take note of. All right. T is 0.35%. Because he is going to do the project. Then what do we call it? He is geared, right? This company is geared. So he is geared because he has 80% of his structure. All right. Then we have what do we call it? V, and D is debt. The debt in this question is 80%, and the equity is the 20. So we have all the variables. What we need to do is to just slot it in, and we are good to go, because so that is the capital asset pricing model for cost of equity for Fameco's US subsidiary. This is the US subsidiary where he's going to do the project, and that subsidiary will be paying. He said, however, the corporate income tax on profit for Fameco's North American operations will be 35%. Don't forget that. Expert is a proxy. Expert is a proxy. Probably the resident people in who are there in the US pay a lower tax than if you come in, you pay a higher tax, well, possibly. All right, so let's slot them in as such. So And this is case study, can be asked to do that. So our KEG, we are a company that is geared. So we took an ungeared 4.89 cost of equity plus 1 minus T. So into bracket 1 minus 0.35 bracket close, KEU again, that is 4.89. All right, so because I'm doing this, I can erase these percentages for a while. I can just keep 4 points because the answer that I'm getting will still be in percentage, 4.89. All right, minus what? Minus KD, which we have ascertained to be 2.1, all right, or into bracket debt 80 over equity 20. So let's see. Of course, you need to do this side first. So 0.65 it is. Into bracket 4.89. Yes, 4.89. 89 minus 2.1 brackets close. So that is it. Multiply by 80 divided by 20, then plus 4.89. So the final answer I have is 4.14%. So that is that. Good. So that is the end of everything. All right. So that is the end of everything. From here, they have, so the correction must be done on the tax rate because the tax rate for Famicor is not the same as XFED. All right. So these are the theories of CAPM. I mean, the advantages and the disadvantages of CAPM. Just take a glance at it as I keep it on the screen. All right. So it considers systematic risk. Theoretically, the best practice to generate KE instead of the GVM model and all the other models is superior to the WACC in providing a discount factor. It shows the relationship between risk and return. The CAPM formula is having assumptions that things are risk-free, but there's nothing like risk-free. You remember that you're a Ghanaian. So you keep these things. So in the part 3, under business finance, our focus now will be on how to do the cost of debt. Then we will do the preferentials. Then we will now combine everything to do the work. All right. So stay put. God bless you. See you in our next video.